Hi, welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management, and thank you for giving us a few minutes of your time to learn about what investors are focusing on right now and how that fits in with your portfolio construction and asset allocation. Now, in our last episode, I spoke about some of the risks and opportunities to watch out for following the market correction in early August. Since then, we've experienced some healthy rebounds in risk assets, and since then, investors' concern of a U.S. recession have eased to some extent. Asian markets, from Japan to Taiwan, have recovered some of that lost ground. Now, we've just released our latest guide to investing in Asia. This is a supplementary publication to the Guide to the Markets, as this focuses on primarily the economics and investment opportunities in Asia for our global investor base. Now, with the help of this GTIA, I want to address three questions that we've been getting a lot from our investors in the US, in Europe, and of course, from the rest of the world. Now, these three questions I want to address are whether investors should still invest in Japanese equities, the outlook for AI and tech-related companies in Asia, especially Northeast Asia, and finally, how the upcoming US elections impact on Asian equities. Now, in Japan, the unwinding of the dollar-yen trade has prompted a sharp correction in equities. Hence, one question is whether this unwinding is over. Now, if we look at the right-hand chart on page 35, you can see that the yen was much weaker than suggested by the interest rate differential between the US dollar and the Japanese yen until the recent correction, with the Bank of Japan announcing its reduction in bond purchases and also the rate increase in July, as well as the prospects of rate cuts by the Fed later this year. There's been some meaningful convergence in US dollar-Japanese yen interest rate differential. And as a result, the yen rebounded significantly. We believe that the Bank of Japan would probably keep rates unchanged for much of this year and has already communicated its plan to reduce bond purchases. Now, what this implies is that the JGB yields should rise in a much more modest fashion in the months ahead. For the US, Fed's rate cut path will be determined by how fast Treasury yields will decline. But now, the market is already pricing in a total of 200 basis points cuts between now and the end of 2025. Hence, the risk of a sharp rise in Japanese yen is somewhat limited in my view. Now, meanwhile, investors should not forget that corporate fundamentals of Japanese corporate sector remains largely robust. Ongoing export strength and domestic recovery are expected to contribute to earnings growth for both 2024 and 2025. Moreover, the corporate reforms are likely to continue in the years ahead. For example, a better use of company cash to engage in share buybacks or dividend payouts of company management that cannot find projects that adds to shareholder value. Hence, our investment case for Japan remains largely unchanged. For AI and technology, we mentioned in the last episode that global investors are reassessing the business case for AI services, taking into account regulatory risks and how to monetize these technology. For markets such as Taiwan and South Korea, the ongoing export recovery should continue to support corporate earnings, and demand for equipment to drive data centers and consumer electronics is likely to stay strong. Taiwan and South Korea's earnings growth forecasts for 2025, i.e. next year, are 18% and 30% respectively. So this is more than just a rebound from the lows of the past 2 years. Moreover, technology and AI to us is a multi-year growth theme, and the recent corrections should be seen in the context of interesting opportunities to add to Northeast Asian tech exporters. Now, on the US elections, the presidential race is becoming a closer race between Vice President Harris and former President Trump. There are many areas of policy differences between these two candidates. However, the overall US trade policy towards China probably will be quite similar. We could see more tariffs against Chinese exports overall. As a result, the ongoing shift in global supply chain is likely to continue or become more indirect over time. More products should start the manufacturing process in China but pass through another manufacturing hub such as ASEAN or Mexico before reaching the US. This implies infrastructure investment prospects that would benefit materials, industrials, and financial companies in these markets. So overall, we still see many long-term investment themes from Asian economies. This includes the rising priority of shareholders and creating value for them for Japanese corporate management, the long-term development path for AI and technology, as well as the ongoing shift in the global supply chain. Now, when investors are always exposed to short-term volatilities, it is important to keep an eye out for long-term structural trends and related investment opportunities. So thanks for watching. Our guide to investing in Asia is available on the JP Morgan Asset Management website, as well as our Market Insights app, or you can reach out to your JP Morgan Asset Management client advisors as well. If you enjoy this podcast, please share this with your friends and colleagues and subscribe. I'm Tai Hui. I'll see you in the next episode to discuss what's on investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.